The car market crash is way uglier than you think, and the truth is, most people have no idea how deep this rabbit hole goes. Dealers, banks, and automakers are doing everything they can to keep you from realizing just how bad things have gotten. But behind the glossy ads, the fake sales, and the talking points about a soft landing, the auto industry is quietly imploding. Right now, dealerships across the country are hiding the truth about used car prices. Trade-in values have fallen off a cliff, and they don't want you to know it. 18 months ago, that SUV you bought during the pandemic might have fetched $35,000 on trade-in. Today, dealers are offering barely half that. People are walking into showrooms shocked. Their cars are suddenly worth thousands less than what's left on their loans. Dealer lots are overflowing with unsold cars, and yet they're pretending everything's fine. They're stacking vehicles bumper to bumper, posting old inventory as new arrivals, and using creative lighting and angles in ads to make their lots look busy. But if you drive by in person, you'll see the truth. The cars aren't moving, and it's not just the dealers. Banks just pulled the plug on auto loans, and this is where the crash turns deadly. Lenders are tightening approvals to levels we haven't seen since the Great Recession. Interest rates are climbing, loan-to-value ratios are collapsing, and even buyers with solid credit are getting rejected or offered sky-high rates. It's freezing both the new and used markets in real time. Delinquency rates are surging, repossessions are quietly ramping up, and the number of borrowers underwater on their car loans is exploding. Banks are slamming the brakes because they see what's coming. A wave of defaults that could rival 2008, but this time, it's sitting on 4 wheels instead of a mortgage. Meanwhile, automakers are in full-blown panic mode. The EV gold rush that was supposed to save the industry has turned into a nightmare. Tesla's relentless price cuts have sent shockwaves through every automaker's balance sheet. Ford is losing tens of thousands per EV sold. GM is slashing production targets, and even Mercedes is struggling to move their luxury electrics off the lot. The EV glut is real. Tens of thousands of unsold units piling up in storage lots, while factories keep churning them out. Automakers are trapped between massive production costs and collapsing consumer demand. The result? A brutal price war that's erasing profits and draining cash at record speed. The signs are everywhere. The auto bubble is bursting, and it looks eerily similar to the 2008 housing collapse. Back then, it was subprime mortgages. Today, it's subprime auto loans. People financed overpriced cars at insane rates during the pandemic, and now those cars are worth far less than the debt attached to them. Repo lots are overflowing again, with banks quietly writing off bad loans and auctioning cars at massive losses. The same patterns that led to a financial meltdown in real estate are now replaying in the auto sector. Inflated assets, easy credit, and a hard landing when reality finally hits. And the reality is brutal. Used cars are crashing harder than anyone realizes. The Manheim Used Vehicle Index, the benchmark for used car values, has been plunging month after month. Trucks, luxury cars, and especially EVs are seeing price drops of 30 to 50%. People who overpaid during the COVID frenzy are now trapped, owing $40,000 on a car they can't even sell for $25,000. Social media is filled with stories of buyers trying to trade in vehicles and being offered laughably low numbers, sometimes less than half of what they owe. Dealers know the resale market is collapsing, so they're protecting themselves by offering rock-bottom bids. And behind the scenes, dealers are getting desperate, pulling every trick in the book to move metal. Remember those market adjustments where they were charging $10,000 over sticker? They're gone. Now it's hidden rebates, secret cash offers, and manufacturer bailouts just to keep cars moving. Dealers are quietly offering thousands in unadvertised discounts, hoping to make sales without publicly admitting how much prices have fallen. Fake sales events, one-day clearances, and exclusive VIP deals are everywhere. Smoke and mirrors to hide the panic setting in across the industry. Even the once untouchable trucks aren't safe. $80,000 pickups are now worth $40,000. The meltdown nobody saw coming. F-150s, Silverados, Rams, all plummeting in value as the flood of lease returns and repos hits the market. Dealers can't move them fast enough. CarMax and AutoNation have started rejecting trade-ins outright or offering insultingly low prices. What was once America's most profitable vehicle segment has turned toxic. Fleet buyers are dumping inventory early, and used truck lots are stuffed with nearly new models at fire sale prices. And the scariest part, the coming wave of repossessions is about to get ugly. Data from major lenders shows delinquency rates at their highest levels in over a decade. Repo lots are filling up with 2022 and 2023 models, vehicles that were financed at inflated prices with minimal down payments. As those repos flood the auction market, prices are going to collapse even further. It's a vicious cycle. More repos mean lower prices mean more people underwater, and more people underwater means even more repos. Even automakers are starting to panic quietly. GM, Ford, and Toyota are freezing production lines and delaying new models because they see what's coming. Behind closed doors, insiders are leaking that the inventory buildup being reported isn't efficiency, it's fear. Factories are slowing down, orders are being canceled, and future models are quietly shelved. The industry knows the crash has already started, but they're hoping to control the narrative before consumers lose all confidence. And yet, nobody's talking about the real reason prices are falling. Mainstream headlines keep saying the market is stabilizing, but the truth is far darker. The truth is, the market isn't stabilizing, it's imploding from the inside out. The real reason prices are dropping isn't just higher interest rates or softening demand, it's because the system was built on fake money, inflated values, and reckless lending. During the pandemic, everyone from rental fleets to dealerships to ordinary buyers paid way over sticker just to get anything with 4 wheels. Banks happily handed out 84-month loans at inflated prices, pretending these cars would hold their value forever, but the math never worked. And now, the bubble is finally bursting. What's happening right now is a slow-motion collapse that no one in power wants to admit. Corporate fleet dumps are quietly flooding the used market. Rental giants like Hertz and Enterprise are offloading thousands of vehicles early, trying to avoid even steeper losses. At the same time, repossessed cars are piling up faster than auctions can move them. Some of the biggest used car auctions in America are slashing prices 10% a week just to clear inventory. The numbers don't lie. Prices are falling, demand is frozen, and supply is exploding. That's the definition of a market crash. And while the media is busy calling it a correction, insiders know better. Dealership footage leaking online shows entire lots of unsold vehicles sitting for months. Salespeople are admitting off camera that nobody's buying, not even with special financing or zero down offers. Banks are cutting dealer floor plan credit lines, which means even the dealers can't afford to keep their own inventory. This is exactly how markets unravel, slowly, then all at once. But here's where it gets even uglier. The consumer side of the equation is breaking too. Millions of Americans are sitting on negative equity, meaning they owe more than their car is worth. Some people are $10,000, $15,000, even $20,000 underwater on vehicles they bought just 2 years ago. They can't sell, they can't refinance, and when the transmission fails or payments fall behind, they lose everything. That's why repos are about to surge, not just among subprime borrowers, but middle-class families who simply overpaid at the worst possible time. And once those repos hit the market, used car prices will fall even further, dragging everything else down with them. It's a chain reaction that dealers, banks, and automakers can't stop. Every repossessed or fleet dumped car that gets sold at a loss resets the market lower. That's why the sticker prices on brand new models are quietly being slashed, even if the official MSRP hasn't changed. Automakers are handing out backdoor incentives, secret rebates, and dealer cash to cover up the collapse. Meanwhile, EVs are turning into the biggest financial disaster in auto history. The rush to electrify was supposed to be the future, but the reality is brutal. Unsold EVs are stacking up by the tens of thousands. Buyers are realizing they don't want the hassle of limited range, expensive repairs, and steep depreciation. Tesla's endless price cuts have shredded resale values for every other EV on the market. A used Ford Lightning that sold for $80,000 2 years ago is now struggling to get $40,000. GM's Blazer EVs are sitting on lots for months, and luxury brands like Audi and Mercedes can't move their electric lineups without massive discounts. The financial bleeding is enormous. Ford admitted billions in losses from its EV division, GM quietly canceled or delayed multiple models, and even Tesla's profit margins are shrinking. What was once the hottest trend in automotive history has turned into a graveyard of unsold cars, panicking investors, and abandoned projects. But this isn't just about cars. cars. It's about confidence. Consumers are losing trust in the system. They're realizing that the car market recovery was built on smoke and mirrors. Dealers lied about demand. Banks ignored risk. Automakers pushed overpriced vehicles into a weakening economy. And now everyone's paying the price. Yet through all this chaos, the biggest warning signs are still being ignored. The same way experts dismissed the housing bubble in 2007, they're now dismissing the auto bubble in 2025. They're calling it temporary. They're saying prices will normalize. But insiders know when credit tightens, repos surge, and manufacturers freeze production, it's not temporary. It's the start of a collapse. And if you think things are bad now, just wait until the next phase hits. Because the next wave, the one already forming behind the scenes, will make this downturn look small. It's the point where the financial system starts choking on its own bad loans. You see, when millions of auto loans go bad at once, it doesn't just hurt the borrowers, it ripples through the entire economy. These loans are bundled into auto-backed securities, just like the mortgage-backed securities that triggered the 2008 crash. Banks sell these loan bundles to investors who believe they're safe, steady returns. But as repossessions climb and resale values plunge, those safe investments start bleeding money. The cracks are already forming. Hedge funds that bought billions in auto loan securities are quietly taking losses. Smaller lenders are shutting down or merging to avoid insolvency. Even the big names, Ally, Capital One, Santander, are tightening credit and pulling back from risky borrowers. That's why approvals are plummeting, even for people with solid credit scores. The system is clogging from both ends. Too many bad loans on the books, and not enough new ones being approved to keep the machine running. And while this credit freeze spreads, the consumer squeeze is reaching a breaking point. Inflation is eating into household budgets. Wages aren't keeping up. Insurance premiums have skyrocketed. Gas prices fluctuate wildly. Families that could once afford a $700 car payment now can't keep up, and many are defaulting in silence. Repo companies are busier than ever, towing away cars in the dead of night, while lenders try to quietly liquidate assets before the storm becomes public. This is why automakers are slamming the brakes on production. Behind the PR statements about strategic realignment and market recalibration, what's really happening is panic. GM has paused multiple EV projects, Ford has cut shifts at key plants, and Toyota is quietly delaying model launches. They're trying to stem the bleeding before inventories drown them. They know that if they keep building at the current pace, they'll end up with hundreds of thousands of unsold vehicles and billions in losses. And then there's the dealer side, the front lines of this crisis. Many dealers are barely hanging on. Their floor plan loans, the credit lines they use to stock inventory, are becoming impossible to service. Interest costs have doubled or tripled. Some are already defaulting, surrendering their inventory back to the bank. That's why you're suddenly seeing liquidation events and inventory blowouts popping up everywhere. They're not promotions, they're survival tactics. Dealers are dumping cars before the repo man comes for them next. At the same time, consumer sentiment is collapsing. People who once saw cars as symbols of success now see them as financial traps. Online forums are filled with stories of buyers regretting their purchases, stuck with depreciating assets they can't escape. Even lease customers are feeling the sting. Their buyout options are now thousands higher than market value, leaving them stranded. This loss of confidence is devastating for automakers because once consumers lose faith, it takes years, sometimes decades, to win it back. And if you look at the bigger picture, you'll see what's really happening. The auto market is entering a deflation spiral. Prices go down, consumers hold off on buying, inventory builds up, and prices fall even more. It's the same loop that crushed housing in 2008. The illusion of stability is gone. What's left is fear and delay. People are waiting, watching, and refusing to spend, which only accelerates the crash. Yet through all of this, the mainstream media continues to sugarcoat it. They'll tell you prices are adjusting or that demand is seasonal. They'll cherry pick data from one strong sales weekend to claim the recovery is back. But behind the curtain, insiders know the truth. The collapse is accelerating, and the reason no one's talking about it is because the industry depends on keeping you in the dark. But here's the thing, you can only hide the truth for so long. When repo yards are overflowing, when dealers start closing, and when automakers begin begging for government relief, the illusion shatters. We're on that edge right now. The signs are flashing red, the data is undeniable, and the reality is about to hit the mainstream like a freight train. And the question everyone's afraid to ask ask is, what happens next? Because once this auto bubble fully bursts, the fallout won't stop with cars. It's going to spread into the broader economy, the banks, the job market, even the housing sector. The auto industry is one of the biggest employers in the world, from assembly lines to parts suppliers, shipping companies, mechanics, and dealerships. When the car market crashes, it's not just about vehicles losing value, it's about an entire ecosystem unraveling. Think about it. When people stop buying cars, factories slow down or shut down. That means layoffs, thousands of them. Those laid off workers cut back on spending, which hits restaurants, retail, and housing markets in their towns. The suppliers that make everything from semiconductors to seatbelts start bleeding cash, and the trucking companies that haul vehicles across the country suddenly have empty trailers. It's a domino effect that ripples through every layer of the economy, and it's already starting. Ford has frozen hiring at several plants. GM has offered early retirement packages to thousands of employees. Smaller suppliers, the mom and pop machine shops, and plastics manufacturers are quietly closing their doors. We're seeing the same warning signs we saw in 2008, a slow but steady contraction of demand, followed by a wave of layoffs and bankruptcies that hit like a tsunami once the numbers go public. Meanwhile, the financial side of the crash is getting more dangerous by the day. When lenders pull back, dealerships can't finance new inventory, consumers can't get approved, and automakers can't move their cars. The entire system is built on credit, and when credit dries up, everything freezes. That's what we're seeing right now. The Federal Reserve's high-rate environment has made borrowing too expensive, and buyers who were stretched thin at 5% are now being quoted 10% or higher. That alone has priced millions out of the market. And while the Fed may eventually cut rates, it won't matter. The damage is already done. Car values are falling faster than loans can adjust, meaning even lower interest rates won't stop the bleeding. This isn't a short-term cycle. It's structural. It's the bursting of a decade-long bubble inflated by cheap money, easy credit, and hype. Let's be real. During the pandemic, everyone believed cars were the new gold. Dealers marked up prices by tens of thousands, and buyers still lined up around the block. People financed $70,000 trucks with little to no down payment, convinced that the value would hold. And for a while, it did, until supply chains recovered and reality came crashing back. Now those same buyers are stuck. They can't refinance, they can't sell, and they can't even trade in. They're locked in financial quicksand, sinking a little deeper every month. And yet, the industry keeps trying to spin the narrative. Automakers are using every trick in the book to delay the inevitable, from creative financing to lease extensions and loyalty bonuses. But these are band-aids on a deep wound. None of it changes the fact that inventories are swelling, margins are shrinking, and profits are evaporating. Even the so-called strong brands are feeling the heat. Toyota's used car division has reported price declines across nearly every model. Honda's sales teams are quietly offering dealer-only incentives just to move CR-Vs off the lot. And luxury brands like BMW and Mercedes are quietly piling up unsold vehicles in off-site storage lots, hoping no one notices. And when consumers do finally notice, when they see brand new trucks selling for 40% less than last year, it will destroy whatever confidence remains. Nobody wants to buy into a falling market, and that's when the crash goes from slow and quiet to loud and unstoppable. Once buyers realize prices will keep dropping, they stop buying altogether, and the market collapses under its own weight. So what happens next? Experts are already whispering about the next wave of bailouts. Automakers lobbying for government incentives, credit relief, and green energy subsidies to cushion their losses. Banks pushing for looser regulations to avoid recognizing billions in bad auto loans. The same playbook we saw after 2008. Just with different names. But here's the thing, this time the public won't buy it. People are fed up with billion-dollar companies getting saved while ordinary consumers drown in debt. And that tension between collapsing confidence and growing anger is the powder keg that could define the next phase of this crisis. Because once the public realizes just how deep this car market crash really goes, there's no putting the genie back in the bottle. It's not just about overpriced cars anymore. It's about a financial system that's been running on denial, and when that denial collapses, everything that depends on it starts to crumble. You'll start to see it first in the headlines, and major dealer groups file for bankruptcy. Automakers announce massive layoffs. Banks write off billions in auto loan losses. But what the headlines won't tell you is that this was all predictable. Every sign has been flashing red for over a year. Dealers couldn't move cars without massive discounts. Banks were quietly dumping their riskiest auto portfolios. Repo lots were overflowing before the holidays even started. The entire foundation of the auto economy, from production to financing to resale, has been rotting from the inside out. And it's not just a US problem. This crash is global. Europe is drowning in unsold EVs. China's car makers are slashing prices to survive. Canadian dealers are sitting on inventory they can't unload. And Australia's used car market has fallen harder than it has in decades. The bubble wasn't local, it was worldwide. And as global demand collapses, the consequences will echo through every country that built its economy around automotive manufacturing and exports. And that's where things start to get really ugly, because when people are trapped, they stop trusting, they stop spending, they stop believing what they're told. That's how consumer markets collapse, not with panic, but with apathy. When buyers walk away, when they decide to wait just a little longer, the machine grinds to a halt, and that's exactly what's happening right now.